don't launch if you're not ready. If you've got a better, you're going to have a better team, better track record, refine the strategy more, a year from now, you should launch a year from now.
In this episode of Investors and Operators, we are talking with Fred Malloy, who is the co-founder of Harken Capital, and we're going to talk all things first-time funds, emerging managers, and a whole lot more. Fred, it is awesome to have you here. Let's start off with, first off, a little bit of overview of what is Harken Capital, your background, how you got into this, and then we'll dive into the meat of this and talk first-time funds.
Sure. Well, so Harken Capital is a placement firm, and most of what we do is funds 1 through 3. But we were really founded to focus on fund 1s 15 years ago. And if you recall, there was a bit of a financial crisis at that time. And so while the first year or two were a little slow, we've been on a tear ever since. And I would say about 60 or 70% of what we do is top offs of funds 1 through 3. And the balance is still what we originally founded for, just launching brand new franchises, getting involved at the very beginning. And the reason that's the original strategy is that's what me and my co-founder started off doing. So he was at SV Life Sciences as employee number 6 in the 90s when they had a $100 million fund. And he was their CFO and their fundraiser and deal sourcer and did a bunch of different things. The first half of my career, I was at a variety of strategies in private equity, but in 2006 took a job that was at an independent sponsor. We called it a pledge fund. And we...
How many different names have there been for independent sponsors? It used to be called what? Merchant Bank, Pledge Fund, Fund List. Now that it sounds good. Okay, we're independent. What other names could there potentially have been?
Well, so my first independent sponsor I worked at was called Watermill Ventures, and it's now called Watermill Group. But they're still, this was in the 90s. And we didn't even have a name for ourselves. We didn't know anyone else who didn't have a fund. In Boston, there are a lot of people with funds at that time. And we were doing deals half with kind of the family money and half with kind of what we called friends of Steve, which were, the founders, friends and different people he met through YPO. But yeah, we didn't even have a name. We were just, it was a miracle when you got a letter of intent signed because, people didn't really understand, what, you don't have the money? It's like, no, we'll find it. We've been around since the 70s. We've done lots of deals.
We could come back to that. We can go back to the evolution of independent sponsors. But Sorry, keep on going with what you're saying.
Well, yeah. So back to the Harken story. So the first half of my career, I was mostly on the buyout side, and 2 independent sponsors, and the one that I call it my crossover job, where I became the fundraiser. I had been trained at a firm called Capital Resource Partners in the cold calling, TA associates, direct sourcing deals methodology. And I took that to fundraising in 2006. And really, we launched the fund in 2007 and had a great success launching a firm that's called Director Capital, raised a $280 million first-time fund, and really started thinking this startup side of private equity is so exciting and fun, whether it's coming up with the name, setting the strategy, recruiting the team. I decided I really wanted to spend my career there. And the other part of that was that because I had graduated business school in '01 during the dot-com crush, I had moved around a little bit. I had done too many different strategies. I wasn't building my own track record to be in the corner office myself someday. And so I was really thinking about, long term, what do I want to be? And so helping launch these new franchises seemed like a great place to go after the Intervale success. But at that point, I was 1 for 1, probably 34, 35 years old, 1 for 1. And I recognized that wasn't a very inspiring sales pitch to the next client. And so I found a partner called Don Nelson, who, as I said, was at SV Life Sciences. And like me, he'd sat on 4 boards in his career. He'd led some deals, but he had left SV a year earlier to hang out a shingle. And he was having his own thought that he might, like to have a partner, but he had proven it, done it a couple. He'd been a fundraiser for a decade, and B, he'd had 2 independent assignments before we got together. And so, we spent the summer of '08 getting to know each other. and launched the firm in the auspicious month of October '08. But yeah,
So,
ever
so you,
since
you have seen funds raised in difficult environments, which is somewhat similar to the fundraising environment and where we're at now.
well, I wouldn't say it's that similar, to be honest. I mean, it is a tough fundraising environment, but there was complete paralysis in 2009. I mean, there were obviously a handful of funds got raised, but the biggest thing happening at that time were LPs saying, we're not going to default on our capital calls, but you better not call capital.
Yeah.
And the
Well,
GPs listened.
what do
So
you think LPs learned from investing at that time that they're applying now going into a potential soft economy and also a difficult fundraising environment? And they're like, hey, we should have invested with good managers who we knew could weather the storm. And guess what? We're going to get great returns because we knew when to back them. But what kind of conversations have you seen? What lessons have you seen these LPs apply?
well, I think LPs, to their credit, they learned the lesson of better to be a buyer than a seller in tough times. And Harken had a record-breaking assignment in 2020 or 2020. And, we just crushed it on an assignment. It was a secondary fund, and the LPs, who had been around for a decade at that point, they remembered things that they sold at a steep discount in 2009, and they remembered that they wished they had bought stuff. And so they thought, there was obviously a pause in 2020 with the pandemic, but in the second half of the year, LPs were like, all right, I'm kind of behind on my plan. The world didn't end. And oh yeah, Fred was calling me about that secondary fund.
Well, how much do you think that the people who went through that cycle, who are now at the institutional LPs, are they, I guess, the people who are getting exposure to the emerging managers, the first time funds, those points of contact, to what extent have they lived through that? Or is it, hey, they're now at the CIO level, and so the emerging managers, their messages isn't even getting through. So how much is that lesson truly being filtered down to the rest of the investment committee at the LPs? So they do see these types of opportunities with first time funds.
Well, yeah, that the part of human nature where people just want to re-up, with the managers that they've backed in the past. Particularly we've been in a long boom, right? Where, even marginal strategies were making good money. And so, the bias to re-up continues to be strong. But to your other question about, kind of who lived through that segment. Yeah, I mean, I was like young guy when I started the firm, and I've definitely followed some LPs around to like 4 different jobs, and they've gotten promoted along the way, right? And so this has been some of that turnover and seasoning of the humans that I met during my early assignments, with them now either director of private equity or CIO level, has been great for Harken because our relationships have just kind of moved up the food chain. And but you're right that there's a bit of an issue of the original, like the deal screener, kind of the first person to take a look at a new manager. They often didn't live through that. And even if I've known someone for 15 years, they don't really want me to send them every single deck, or they're not at least taking the first meeting. They'll look at the deck and they'll send it on to the person who focuses on that area. But yeah, it is a bit of an issue. But go ahead.
So do you think that is a potential fundraising lesson for these GPs of make sure that if you're a first time fund, that your message is getting through to the people who have seen '09, who have seen it, as opposed to, no, first time fund, talk to you at fund 2. Let me get through this next few years.
I think regardless, you need to get in at a pretty high level in these firms if you can. But there's also merit to just going to the right level of person who does the first screen and build a relationship with him or her. There's a lot to how to do this, and it's not really a science. It varies really by client, by LP that you're talking to. But if you can build a relationship with that champion and then give him or her the tools to show up on their Monday meeting and saying, look, we've got a lot of re-ups this year. We're going to do one interesting thing, and this is it. And here's why. You've got to make your champion at the LP able to sell internally, whether it's to their boss, their client, their board. They always have to sell it to somebody. And, I mean, when I was first starting off on this, I had a few clients saying, "Oh yeah, I can close. Just get me in the room with the billionaire, and I'll get $20 million commitment." And it's like, it doesn't work that way. The billionaires have a team, they have a staff. They don't want to do the idea that's, just popped in, and was persuasive in the conference room. They want to have a process.
Well, let's dive into that on how can GPs and the placement agent who advises them, how can GPs most effectively give their internal champions the tools to sell internally? What does success look like, and what does failure look like in terms of giving that internal champion at the potential LP the tools to succeed and sell you?
Again, it's very case dependent, but what I'll say is, as a new firm, you've got to be doing something new and interesting, right? And so you can't show up, we're in a mature industry, right? So if you show up and say to some family office, "Hey, I do software buyouts," or, I do, fintech growth, or, if you just sell your category and then think they don't already have that somewhere else, you're a little naive, right? So like most LP, there obviously are people building a program, and those are people we love to get in front of because you're not fighting the re-ups. But for most LPs, they have a very mature program, and you need to bring them something new. And so if it's really hard to explain, that is maybe proof that it's new, that they don't already have it. But it's if it's too narrow or nichey or hard to explain to them, then they're not able, they may say, "Huh, that's interesting, but I'm never going to be able to explain this to my boss." And so you just get in this, we'll take a meeting, but we're not going to progress kind of a situation with people.
Well, what does that first screen look like? What is the checklist of that first screen to say, "Hey, this is interesting," not for a first-time fund, for a average institutional LP that has some experience working with first-time funds? What does that first screen checklist look like?
I think the most important thing is the team. So, and we'll talk about track record in a second, but with regard to the team, ideally you're coming from firms that they've heard of, whether they've invested or they just kind of vaguely are aware that that's a good training ground. You could be coming from Bain Capital, a big fund, or you could come from, a different emerging manager where you're like the next layer of the spin out. But at least if they have some sense that it's, you're coming from somewhere they've heard of, it helps a ton, because then they feel like they can diligence you. But, for guys and gals, and there's a lot of them who've been doing their own thing for 5, 6, 7 years, and they've kind of come up the ranks in firms that are less recognizable, it's a little bit harder. They might have a great track record, but just kind of team, if we can say it's a spin out from X, then there's a little pattern recognition, and we get more first meetings.
And the brand and the branding of that firm.
Right. And then on to track record. So it's team and then track record. And so what have you done? Right. And so, track record is, the SEC has more and more requirements, and firms are getting smarter and smarter about letting people walk out with the track record. And so in some ways that helps the first time funds say, "Oh, well, we've got a great track record. We're just not allowed to put it in the deck." But you've got to figure out how to communicate your track record to people. And ideally that includes round trip realizations, right? Like, it's not just, I've deployed 300 million. No, you need to talk about the value you've created, whether it's write-ups or sales. But it's there's ways people talk when they're talking to deal sources and brokers and bankers. It's like, "Yeah, I've deployed 300 million. That's like amazing that you've done that over the past 7 years." But LPs care not about deployment, they care about returns. And so the things you brag about are just different from an LP. And then strategy is the last kind of major, if we're thinking just 3 legs on the stool, what is the strategy? And, is it interesting? And is it going to be, is it easy to explain, as I was saying before, but is it a strategy where they think, "Huh, that could make sense?" And so what we've done at Harken many times, and we did this at Intervale, which was my crossover job where I was in-house fundraising. We say, "Look, here's our strategy. We're not smarter than these guys that now have the $1 billion funds, but they have the $1 billion funds. they're not doing the deals where they did 3, 4, 5x deals anymore. They're smart, they're great, but frankly, they're fat and happy, and they're working on their 5 homes and their 3 boats, and hopefully doing good deals for you. But think back to when you first backed them. What was the track record, and what are you getting now? We're the ones doing those deals now, and then we're selling to them our mature businesses in very efficient auctions. That's been a successful play for us, many in many different strategies. So you're not scaring the LP that the big guys are, if you go too hard, which I kind of did just then about their boats and houses, then they start saying, well, those guys are geniuses, they delivered us consistent 1.7x's. So you don't want to go too defensive and make them feel bad for commitments they've made. But what you do is you say, you don't have to fire them, just don't scale up with them, and carve out some allocation for this, because we're generating alpha at the lower end of the market, and we're selling into a more efficient market. That's been very successful for us.
Who should not raise a fund right now and should just focus on doing more independent sponsor deals for the next few years? What are the different, if you use that 3-part screen, like, can you break that down a little bit more on who should not raise a fund right now?
Yeah, I mean, if you don't have any round trips as an independent sponsor, it's going to be very difficult to cross over to having a fund. So you got to exit something. And I had a client once who talked about how people drink the cold beers first. It's a real challenge, because you don't want to, if you have a deal that you think is a 4 or 5x, if you hold it for another year, but you can sell it for 2.5, 3x now, and then build your firm off of that return, that's a real debate. And what we encourage people to do is ride it to the 5x, because that obviously you personally make a lot more money on that carry wise. It delays when you launch your fund, but with LPs, they don't want you to do that to them, right? You need to, we're maximizing the outcome for our investors, and here's how we're doing it. If we have to hold it 6, 7 years, we will.
What about on best track record? What about on team? Like, who should not raise a fund because of certain team dynamics, and what do those team dynamics look like?
So there have been a lot of people raising funds with one person who's amazing, and they come from a big name firm, and the LPs, they've known some LPs at the decade they were at the big firm. And so it can be done with, really kind of one founder. When I started in this business, there were a lot of you need 6 senior members, 3, 4 people on the investment committee, each with investable track record or attributable track record. That's definitely changed. But the one person who can raise a fund just on their deals that they did at some big firm, it's pretty rare. And so much more common, you really need, if not a full founding partner, you need someone who's, within 5 or 7 years of your age, who's got a great resume and you've been with them for a while. And so building a team is expensive. We understand that. If you don't have more assets under management, every time you hire someone, you're taking a pay cut personally, right? So we understand there's a tension there, but you do kind of have to build the team and act like a $200 million fund, even though you don't, have the 200 million under management, if you're going to get there.
What percentage of first-time funds that have raised, this is a ballpark estimate, do you think are truly one founder who came from a good track record, good firm, and they just hire the team?
Yeah, it's hate to do a Star Wars reference, but there's usually 2. The Sith Lords usually there's 2. So, we've had some successes where there was like a 48-year-old guy and a 38-year-old guy. They'd worked together, a decade earlier, then they were at different jobs for a little while, but now they're back together.
Yeah.
And, there have been kind of one founder situations where they own the management company, they're the prime mover, but they get people that are about their age. But yeah, I really, we have, Harken's been successful with, these young firms and funds that I've been talking about, but our market share across the 4,000 funds in the market, it's near zero. So I really can't generalize. on, what percent of funds have two
Yeah,
real
well,
founders versus like a kind of a wing person.
well, maybe double click on this on the team a little bit more of what do good teams look like throughout the fundraising process, and how do teams not perform well throughout the fundraising process? Like, what are some of these common threads of success and failure?
Yeah, so one easy piece of advice for people is don't have a team page with the grayed out pictures of athletes to be named later. It's just bad. Like it, what, we use DocuSend sometimes on the decks, and we have data that LPs spend like 2 to 5 minutes on a deck before they take a meeting. And they go to 3 pages. They go to this executive summary page that we create, which tells the whole story. They go to the team and they go to the track record. And if you give them a quick reaction, they don't have to read anything. If they just see multiple like to be named laters, they're like, I'll be looking at this later. And they're smart, right? They're not LPs get a bad rap as being, they don't work as hard as GPs. No, they make rational decisions that they don't want to push something, uphill and get turned down at their own investment committee. And so if there's a reason for no, like an incomplete team, they'll say no immediately. And so what you have to do is say, our team today is capable of deploying 100 million or 200 million or whatever the target is. And, if you need another analyst or associate or whatever, that's fine. Those are kind of viewed as commodities. You can find them. There's a cycle. You can always say, oh, we've got offers outstanding, so-and-so starting in June. Like that. Again, I don't mean to minimize the complexity of it, but from a fundraising standpoint, LPs can say complete senior team. And, yeah, of course, they're building out the bottom half of the team. Everyone does. Sorry, was that answering your question?
Yeah, no,
I got off on a tangent there.
That's really good. And let's dive into that. So what you're saying is like the only thing that they truly care about to do this initial screen is like 3 things: exec sum, team, track record, those slides.
Yes.
Should they start in that order?
Well, if the track record's on slide 27, you've got a problem.
There's a reason.
Right? Yeah, it doesn't have to be slide 3. Sometimes you want to talk about the strategy in 2 slides or something. But if it's not in the first 5 pages, it's like, what are they hiding? Why are they making me look for this? Actually, kind of a funny story. So I made this mistake when I was at Intervale. We were at a meeting at HarborVest. Ed Kane showed up, who was one of the co-founders. And, there was no Zoom then. So this was the first meeting. This wasn't like pre-qualified or whatever. But I think our strategy was pretty interesting. And I had set the meeting I had an offer from there coming out of business school. So I knew some of the guys. I don't know if they were being nice to me to invite the co-founder to the first meeting or whatever. But I specifically remember we were on the 29th floor because I almost jumped out of the window because Ed Kane came into the meeting and he's just flipping through the deck. And he gets to the appendix, and it wasn't the track record issue I'm talking about, but he couldn't see where the people had gone to school because I had done a team page that was more like pictures and less like bios. And he's like, he says, he interrupts the meeting halfway through and tells my bosses, the co-founders of the firm, like, you need to find someone who can put a deck together. And I'm just like about to break a chair through the window and jump out of the conference room, because I can't find, blah, blah, blah. So anyway, if there's things they want to see, you got to put it at the front of the deck.
In terms of, and that kind of makes me think about more of the marketing and look and feel of a deck. And have you found in the decks that you have seen that people are putting the time, money, and effort to make it feel polished? Like it's not just a banker's deck, but it has some polish to it. Like it's like, all right, this is institutional, even if it's fund 1.
Yeah, I mean, so I have mixed thoughts on that. And so, I mean, there are some really polished decks that, they hire consultants. It doesn't help if the track record isn't there or is mediocre or whatever. And so, I think if you have all the ingredients, having it look better makes a ton of sense. But, some of our most successful funds have been very text oriented, probably too much text on the page kinds of decks, kind of break some of the presentation rules. And so we do some work in PowerPoint for people. We have a few clients over the years who use like fancier, softwares to make the decks look, better, but that's not necessarily correlated with better outcomes on the fundraise.
So let's go into the first meeting. What does a successful first meeting look like for a first-time fund meeting with an LP? And what does success not look like?
So it's different with different kinds of LPs, and we can talk about that a little bit. But I would say there's two signals at the end of the meeting that are good and bad. And one is if they ask for the data room, not like I have clients that are like, hey, we've got a data room. You want to go in the data room? And what is an LP going to say? They're like, well, sure, send me the link. But they still don't go in. Maybe less than 9 out of 10 times, but many times LPs they get asked for data room and they don't go in. So if you're kind of winding down the meeting and they say, do you have a data room? It's just a little signal that the LP is interested enough to ask for the data room. And because they ask, they're more likely to go in. So that is a quote unquote good meeting. But I don't get paid for good meetings. I would be retired by now if I was paid on good meetings, because every meeting is good. You're smiling on the way to the elevator. But the bad meeting, and we've had commitments come out of bad meetings. So again, these aren't ironclad rules. But the bad meeting is just like, well, we meet on Mondays, give us a call. And it's like they don't tell you anything they liked about it. They don't imply this was interesting. They don't, there's just like a bit of a poker face, and it's like, yeah, we meet on Mondays. And I mean, the other kiss of death can be, I think you're going to be successful. Like there's a few different, like, well, this was more interesting than I expected, So there are definitely comments where, I think a meeting went fairly well. And then at the end, they're just like, I mean, obviously some people are candid and say, we're out of allocation. That's, a little frustrating because you're like, well, why'd you take the meeting? If they're speaking directly about what they liked or didn't like, I think that's kind of a win, right?
Yeah.
Like you're communicating like human being to human being in a way that can be helpful. But just vague comments like we meet on Mondays or wow, I think this is interesting, that's the kind of the bad meeting.
So there are two signals. One, did they ask for the data room? And two, the
just vague lack of like we meet on Mondays, like
all right.
We'll be talking about you. Trust me.
All right. So the two signals are at the end of the meeting. One, do they ask for the data room? And two, to what extent have they been vague on the next steps or level of interest?
Right. Yeah.
Got it. So
and that goes for any client too. That's not just for first time funds. And I mean, there are better meetings than that with can we do data room? Like, I mean, we've had like the best meeting is, I usually do 40 million. And the last time I did a fund like this, they crammed me down to, 17 million. Can I get 40 million in your fund? And that obviously that's like, they're going to have to do their due diligence. It's a couple months away, but you pretty much have a yes. So that's the best meeting, just to be clear. And we do have those, in a typical assignment might have 100 meetings. That might happen once.
How much could and should you pre-qualify that? Because fundraising, it's partly, yes, I need to get this first close done, but it's also developing that relationship. But there's a shot clock. I mean, you got to get the thing done. You got to pay bills. So how do you think about the extent to which you should pre-qualify an LP to really take that meeting? Have meetings just to have meetings and develop relationship versus being super focused on only people who truly have allocations.
Yeah. So there's a lot there. So remind me different aspects of your question as I start wandering here. But so with regard to the shot clock, we like to think about when is the fundraise going to end, not, when do we start? Like, because a lot of people want to hit the market, us too, right? Like I've been living on commission since 2008. So we want to get the sale, we want to get started, we want to make things happen. But if there's a key hire that's going to happen in a few months, if there's a key exit, write-ups, new deal, we can offer some co-invest. Like we like to game plan out the next year and figure out what are the catalytic events that we can use. So before those events, we'll go a little bit softer. Like you want to do meetings, you want to get better at fundraising, have the team coach them up a little bit. And you want to start, people have long timelines, you kind of got to get it started. But if there's some big exit coming up just from let's say it's a typical client, they've been around 6 or 7 years, they've done 6 or 7 deals, they've got one exit, but there's one more that's about to happen, that can start to be like enough to get this fundraised. And so we could just do nothing until that exit happens. But what's more typical is we start the process, and then as that exit, materializes, like you've hired bankers, you've got letter of intent, you've got signed agreements, it's closed. So we'll tell people the good news before it happens, and then we tell them as it happened, and then we're bragging about it, 3 or 4 months later as well.
Yeah.
But you've kind of delivered something you said you would deliver. But there's a danger there if, with 4,000 funds in the market, if I go out with a one exit deck, people just say, call me with fund two. And so anyway, that's why we don't go very broad at the beginning. So that's part of your question about the shot clock. But
So
what were the other elements of your question?
Yeah, it's really just like, how much should you pre-qualify beforehand? Be like,
Right.
Hey, Fred,
Yeah.
do you do first time funds? Yes, no. Cool. Yes, you do. Do you have money? Yes or no for this allocation? Yeah. Like, how much should you do that true type of pre-qualification versus take every meeting, get in front and build these relationships?
Yeah. So a guy, Steve Williamson on my team does a fantastic job at this. And, I think Don and Peter and I, who've, been around a little bit longer, like in some ways, we kind of understand whether someone's a meeting taker or, actually has the allocation or whatever. But Steve does a phenomenal job doing that call ahead of time. It's not just like the 5-minute elevator pitch on the client. Do you want to take a meeting? It's a subsequent call, understanding their check size, their process, their, everything about them. And so he does a phenomenal job at that. So pre-qualification is very important. But one thing I wanted to say about that is, in a Zoom world, we're talking over Zoom. It's wonderful that, we didn't have to like get on a plane to do this podcast. But, from a fundraising standpoint, sure, you can, fundraise in St. Louis and in Tallahassee and in New York on the same day. But there's something lost by lacking the in-person meetings. And the reason I'm relating this to your question is, I'll tell you a story. So I was in Charlottesville with a client, and we were going to see the two biggest LPs there. And we had a fill-in meeting in between with me, what's the third biggest LP, who I barely knew at the time. And I told my client, like, hey, this is our fill-in meeting, but please, bring your A game. They've been kind of out of the market for a couple of years. They just haven't been doing a lot of commitments. But the woman we're meeting with used to work for the guy we're meeting later. And it's, you want to create a little buzz within a community, particularly in the smaller cities. So I told my guys, bring your A game. Well, we walked away. Obviously, it took 2 months of diligence, but we got a $47 million commitment from the fill-in meeting. And so that was like zero pre-qualified. They just met with us because we're in town. We met with them because we're in town. And, they had just shifted
just
to meeting.
Be ready and never know what's going to happen. And don't just count people out because of what you think. And it's not just with the GPs thing, but also just on the placement agent side of just, you never know.
Well, yeah, I mean, we live in a very low batting average world. I mean, if I could boil this down to a real formula, and, if I knew which 10 or 15 LPs were coming into my clients, I would do one assignment a month and just call on those 10 or 15 LPs, right?
Yep.
So we call on 1,000 LPs, we get 100 meetings, and we get 10 or 15 LPs.
How many institutional LPs invest in first-time funds, do you think, ballpark?
Well, hundreds. I mean, tons. Yeah, I mean, there's new ones coming online, RIAs all the time. So, yeah, I mean, I think there's tons of LPs who invest in first-time funds. There's like the ones who have a real firm policy against it, they're often writing too big of a check anyway. So, I mean, we're a small firm, right? We have 6 people. We're not like whining and dining the state treasurers in 50 states, but we get pension money through, the advisors, the people who are whining and dining them, and they'll create an emerging manager program or what have you. But, these large pockets of capital don't typically do first-time funds because of size, not just, kind of risk of this is a first-time fund. It could go wrong.
So 2 more questions come to mind. One is, what does the second meeting look like? And what should they do between first and second meeting to keep the momentum? And then we'll kind of do like some summary thoughts for first-time funds, do's and don'ts in a tough fundraising environment?
Yeah, so a lot there. And again, it's more art than science. It's hard to boil it down to every client. But the one thing I'll say is we talked about the data room and did they go in the data room or not? You cannot call them back, whether it's your agent or you directly, like, hey, that was a great meeting we had 2-3 weeks ago. Have you been in the data room? Give me a call. You need to go back to them with good news. And you need to, just stay in front of them. And so it's like, hey, we did an exit. Remember that, CEO we told you we were hiring, he's joined us. It can be an add-on, it can be a write-up, it can be, hey, here's our quarterly updated numbers. You want to just flow them something new, like they'll click. You want to send, hey, here's a 2-minute video from one of our CEOs. You'll love this because it hits on this theme that we talked about. And that, it signals to them that, you remember the meeting, like that you care, it's a customized email. You're not like mass emailing people. Like, mass emails go in the spam filter. Like we all get them. And, you need to send a customized email as much as you can to people, or send the mass email and then send it again. Hey, just making sure you got this. And it takes time, it's painful, but you kind of have to do it. And if you can customize it to their concern that they articulated in the meeting, or something that you were bragging about in particular that seemed to resonate, then you get them to click. And so we're kind of in the not know business of like, just keep them give news. We're not jamming someone for a yes or no. We just want to get them, to think, oh, maybe I will spend a little more time on that. Maybe I will spend a little more time on it. And then, maybe it's 6 months later, you have that, 4X exit and, they realize, I think my boss, I think I can get this done. And so anyway, so pushing good news is the major thing between any meetings, whether it's the third meeting and the fourth or the first and the second. And sometimes that means waiting, right? Like, you want to have the fundraise by, Christmas Eve, but, if you're selling a company in Q1, you probably shouldn't do a ton of, you don't want a yes or no if you've got a better cards to play later.
Don't necessarily focus on what's happening in the second meeting. Focus on how are you maintaining momentum and building momentum and the different events that you can drip out on a consistent basis. Think about that, plan that, whether it's an add-on, a write-up, quarterly numbers, truly key hires, or something that the LPs are going to care about and it's going to help move the needle. And it's about balancing, maintaining, and building that on a consistent basis to stay in front in a targeted way with these LPs.
Yeah, and the good news of all of that is that that's the main thing you're doing anyway as a private equity investor, right? You need to be serving your LPs and growing your companies and creating value. And that is the main thing that's going to get your fund raised. And so, I tell people all the time, it's not which agent you hire, although we think we do a good job. But if you can do good deals with the first close money, that's going to drive your final close more than these other, which agent you have. And so what I mean by that is, it's often a year to 2 years between first and final close. If your first deals have grown EBITDA by 20% or 30%, the final close LPs are going to, their greed will take over from caution because they get into that deal at, kind of cost plus instead of at market value.
If first time funds are listening to this, if they only remember 3 things from this entire episode, what do you want? What are the top 3 things that you want first time funds to remember from this entire episode?
So this is aspiring first time funds, right? Not people who've already crossed the chasm. So the 3 things that I would want them to take away is, don't launch if you're not ready. If you've got a better, you're going to have a better team, better track record, refine the strategy more, a year from now, you should launch a year from now. That's probably the number one takeaway. And it goes against the grain of, placement agents. If you give a hammer, 3-year-old a hammer, everything's a nail. If you ask a placement agent, do you want to raise a fund? They'll say, yeah, let's start tomorrow. And, that's, we try to be more thoughtful about it. But that's the number one thing is don't launch if you're not ready. I guess the second thing would be, yeah, keep the flow of good news happening during the fundraise. And, you want to have, you've got to be able to kind of follow up with good news. You're not going to get the fundraised on today's story. You're going to get the fundraised on what your firm looks like 6 months from now.
And is there a third, or those two, the 80/20?
I don't know. I mean, I could obviously say hire good advisors, but just a plug for some of your work. I mean, I think using video and, kind of more modern tools to build relationships with this younger cohort of LPs, I think is really important. We've had a lot of success with people, sending out little short videos and getting people to click on it. Like I was describing being in the not know business, getting them to do a little bit more work. But, anything you can do to kind of break through the noise is worth the effort.
And here's what we've done with video is to your points, like executive summary, team track record. Within that framework, a 90 to 120-second video that summarizes who you are, what you do, the strategy, how the team has been together, sending that. Now you could generalize it, so you could put it on your website, LinkedIn, and send it out privately. And then on the track record, having, speaking to these case studies. Maybe if you have a portfolio company, like we just saw 2 portfolio company videos, and they're sending that out to LPs, because then you get to actually see the business, the managers, the people who've worked with these GPs get to talk to it. And then around the team, you can tell what people have chemistry and what people don't. And it's hard to see that in a deck. It's hard to see it when maybe 1 or 2 people are on that first call, but to see it in a video, it just conveys a completely different sense. And one of the things that we found on these videos is that a lot of the first meetings are more efficient because they're not spending 15 minutes talking about what could have been described in 1 or 2 minutes the week before in video. And so it makes it more efficient and makes them interested.
Yeah, no, I'm a big believer in, full disclosure for any viewers. I haven't, you and I are just getting to know each other. I haven't been sending my clients your way, but I do want to encourage my clients to look at your services because, a few have done some of this stuff, but like what I'll say is we've had very little success saying, click on this annual meeting link, because people are like, I've got 2 hours. I didn't know what I wanted to do with. Thank you. Nobody says that, right? But click on this 2-minute video. We've had some success, and you're in this business, and you might someday have a data that says, the 4 minutes is the limit or 12 minutes is the limit.
Well, it's interesting because there are different types of things. Like we literally just did a 67-minute virtual AGM, and LPs emailed after like, thank you for doing this again for the 2nd year in a row. And I think it depends on what that is. But the topics that we have seen in the videos we produced are like, 1, what is the overview of the firm? Like that's the sizzle reel. Then diving deep. So for example, one of our clients is raising a $200 million fund, and they've hired 3 people that are key. So we'll record over Zoom, just simple 2-minute bio videos and we drip that out once a month on this new hire. And that's part of it because you get to see, like, is this person culturally a fit with this GP? And there's so many of these different things that could just be dripped out in a differentiated way. And then you can also target it, and you could get the analytics behind, did they open it? How much did they look at it?
Yeah, that's huge. To be able to see if they viewed it is really important, because you can call them a minute later or a day later, whatever you think is appropriate. Yeah, that can be the good news, right? Like I'm saying, have an exit or hire a new CEO. Well, that only happens so often. But you want the flow of good news between meetings. So, here's a new video we did on that portfolio company we talked about is a great thing to do to just kind of keep engagement, keep your name in front of them. The one debate that, I don't know if settleable yet, but the worry I have a little bit of, like, if people look at a 12-minute video, I get it. I hear you that you can kind of, the first meeting can be like meeting 1.5 if they already heard certain things.
Oh, I would never send a 12-minute video. That would die very early on the editing floor.
Yeah. Well, so I guess what I'm saying is if you've done somewhat of the first, if you do a little bit of the overview in a first meeting for an LP, do they then not take the meeting? Like, did that satisfy their curiosity and then they don't meet? Whereas like some of my hour meetings, like the good stuff happens in minute 55, right? Like some meetings start off really well and they, just kind of go really well. Because the LP starts off
Well,
like, I'm looking for
one of
lower
them,
middle
for
market
example, is
buyout.
like, hey, here's one of our 2 or 3 exits. And then here's a 2-minute video about that. So what is the company? Like, what is this particular manufacturer? And then the last half is, how did we actually grow the business? What value did we create? And then it
Yeah.
allows us to have not just like surface level discussion. It says, hey, I watched that thing. It was really interesting. Can you tell me more about this particular topic? And they remember it. So one of the things that
Yeah.
I was talking with a law firm, and he's like, LPs, when they go to AGM, like literally the next day, they forget what just happened because they have how many other current commitments. And then within a GP, how many portfolio companies do they have? And then how many new GPs are they trying to get their attention? So you have to stay front of mind and just remembered. And so
Yeah.
this is one of those things that helps to move the needle to stay front of mind.
Yeah, no, I definitely agree with that. And so I actually forgot to mention we at Harken invest in our clients' funds. And so I'm in 25 funds now after doing this for 15 years. And it's been phenomenal for us because they're performing well. But I have my own annual meeting season. And we do it because of the integrity of the situation. Our LPs, we're not bragging about this to every LP we talk about, but our core LPs, as they get to know us, they understand that we're in it with them. I'm an investor in the fund. I'll be there. If something goes wrong, it's bad for me too. But anyway, yeah, I understand that. We have our own annual meeting season. And I was at a annual meeting last week, and there were some things that were good about it and some things that were bad about it, but it's fading from memory, right? Just as a little bit of time passes. So I try to
Well,
give my clients feedback right away. Here's what was a hit and here's what was a miss
and
on
a
a
lot of
meeting.
times, like I've found that LPs don't really know what the portfolio companies do. And they need this re-education because they might be across all these different asset classes, all these different LPs, and you have what, 5 or 10 commitments in just one fund. And it's like, wait, what does that vein business do? Wait, what does
Yeah.
a stem cell business do? So like
Yeah.
doing a 101 has been really helpful for them to remember what it is.
Yeah.
But
And one thing in addition to that, so sometimes my clients are just coming off a fundraise and they've just described, like everything is, you want the annual meeting pitch to be different or deck to be very different from the fundraising deck. But sometimes the CEOs go too deep into what they do as if they're talking to a customer. And so that's where your editing comes into play. And I would definitely coach every CEO in every video to say, at the end, the thing the LP cares about the most is, and EBITDA is growing by X, and we're going to sell this company this
so
year for
start
that amount of money.
the front, the hook should be, we grew from 5 to 15 in 2 years.
Yeah,
Here's what we do.
right. You can't go so deep into, every esoteric thing about what the company does and how you're a little bit different from your competitors, because you can lose people on that
Yep.
stuff. Like
We dumb it down.
yeah, they want to come back from the annual meeting, they're going to tell their boss, or their boss is going to say, "Oh, how'd it go at the such and such annual meeting?" And they'll say, "Yeah, I think it went well. I think we're going to make 2x on this fund." And there's very predictable questions. Well, when's the next exit? When's the next capital call? What are the year-end marks looking like? Like there's 2 or 3 questions that if you don't answer them, your LP is going to be stuttering in their Monday meeting, and you're kind of on the bad list. So yeah, I think annual meetings are like their own topic and kind of are like, once you get across the chasm to having a fund, there's ways to kind of keep that relationship
Yep.
tight. I mean, again, the main thing is delivering, right? The main thing is doing good deals that are on strategy, that are, growing in value. But there's all these other little things that matter.
We covered a lot of ground. And I think that we just skimmed the surface on effective first-time fundraising. Thanks so much for taking the time to do this, and excited about getting this out there. And if people want to get in touch with you, what's the best way to reach out?
Yeah, it's our website, harkencapital.com, Fred at harkencapital.com. It's HARKEN capital with an A. But yeah, just shoot me an email or send me a text, or, our numbers are on there. So, but yeah, we're very happy. We give a lot of free advice to folks, and we don't know if they're going to be a client a month away or, a year away. In fact, we're talking to our very first client about helping them out next year, years after the fact. And so we like to be a valuable part of the ecosystem. So yeah, please send people my way. We're happy to chat.
Awesome. All right. Have a good day. Thanks so much.
Yeah, have a good one,
All
Jordan.
right.
Thanks so
See ya.
much.